Hey everyone, I'm TQ. Over the past 2 days, I've been reading a deck by Bitmine's chair, Tom Lee. It's intriguing. He puts out two eye-catching ETH price targets. One says that by end 2025, ETH could reach $10,000. The other is a longer-term target, even as high as 60,000 plus. So today, let's break this material down together. We'll focus on the most rigorous parts. Chapter 2, the macro supercycle, and Chapter 3, the price derivation. We'll ask how those numbers were calculated, what conditions must be met, and how likely they are. The first page of Chapter 2 says, in 1971, the US dollar became fully synthetic. This page is the historical cornerstone of Tom Lee's logic. In 1971, President Nixon took the dollar off gold, ending Bretton Woods. From then on, it was pure fiat, credit-based money. Calling it synthetic is clever. Value no longer tied to metal, but to systems and consensus. He's laying the groundwork. We're at a new paradigm starting line. The next page gives the 1971 backdrop, a crisis of soaring inflation and a rush into gold. Tom's point is that great innovation often comes from crisis. The collapse of the old gold standard paved the way for a new, more complex system, modern Wall Street. Then Tom Lee uses a diagram to show how synthetic dollars catalyzed a new financial system. On the left, the search for a store of value, gold. In the middle, building the synthetic dollar market. On the right, Wall Street. This is the historical model Tom Lee builds. In that model, gold's dominance as a store of value declines. A newer, more flexible form of money, the synthetic dollar, is created, and a new market forms around that money, modern Wall Street, which explodes in size. On the back of it, countless financial products appear. Next page proves the model with facts. A timeline showing major innovations within 15 years after 1971. Money market funds, MBS, interest rate swaps, ETFs. Leaving the gold peg wasn't the end. It was the starting gun for explosive innovation. In just 15 years, the bedrock of modern finance was set. Note this carefully. Tom Lee built this model to foreshadow what's about to replay in the blockchain world. His subtext is clear. Once Ethereum has its 1971 moment, we should expect a decade-plus boom of financial innovation on-chain. That raises Ethereum's long-term value ceiling. Next page. 7 of the world's top 30 companies are financial institutions. Why mention this? To answer, how much value did post-1971 innovation actually create? He's hinting that DeFi and RWA on Ethereum could birth the next era's titans, pushing the narrative ceiling higher. With the history set, we enter the core. Ethereum is going through its 1971 moment, and real-world assets are turning synthetic. Physical world assets, real estate, stocks, bonds, commodities are being mirrored on-chain as tokens. Ethereum, in his view, is the best base layer to carry those synthetic assets. Next comes the Genius Act, a federal stablecoin framework, reserves, oversight, division of roles. This is his first real-world policy catalyst. Regulation catalyzes innovation. Rules are how you scale new systems. The act requires stablecoins to be backed by U.S. assets, especially treasuries. That creates massive new demand for treasuries, aligning with U.S. policy support and pulling millions into the digital dollar economy. Then there's Project Crypto, the second policy pillar. If Genius is about the payment instrument, stablecoins, Project Crypto is about the assets themselves, equities, bonds, etc. This would push Wall Street to tokenize and move on-chain. Together, these two policies form the near-term bull case. Now, the page I find most central, he recreates the earlier historical model. Gold becomes Bitcoin, synthetic dollars become digital assets, and Wall Street becomes Ethereum. With a single line, Wall Street building here, he tells investors the story is rhyming, and the new Wall Street is Ethereum. As before, he mirrors the historical path of product innovation, listing what may emerge over the next 10 to 15 years on blockchains. The point is to spark imagination. If history holds, on-chain innovation explodes, and Ethereum's TAM is enormous. He also shows evidence that the trend has started. JP Morgan, Goldman, Robinhood, Walmart, Amazon, testing stablecoins and tokenization. He calls it the ChatGPT moment, not distant theory, but right at the tipping point. He also cites comments from the Treasury side, arguing stablecoins could reach multi-trillion scale, bringing fees and activity to Ethereum as settlement layer. Then he puts down data. Why Ethereum? Network effects. In stablecoins, Ethereum's dominant issuance and activity concentrate on ETH. 7-day growth on Ethereum can exceed rivals' multi-year totals. That's a moat, hard to dislodge. He shows tokenization metrics. Ethereum is the main arena for real-world assets moving on-chain. It turns an abstract idea into measurable traction. Then the spicy page, Tom talks about a 2017-style 120 Kais move as a thought experiment. It's meant to stretch imagination. Yes, it triggers some FOMO. He also references Ethereum's AI, a former core dev's view that ETH can be decentralized, transparent, verifiable rails for AI. That extends the story beyond finance into tech philosophy and data trust. He cites a June report, BTC as digital gold, ETH as digital oil, productive, cash flowing. Gas fees and staking yields invite a different valuation lens than Bitcoin. Supply side next. Post-merge issuance fell sharply. EIP 1559 burns fees. ETH was net deflationary for long stretches, only recently a bit inflationary. Demand rising while supply growth is muted. That's classic price support. If ETH is digital oil, you can value it like an energy major. Future fees are the reserves. That shifts us from narrative to numbers. On technicals, he notes a bullish structure, higher lows. That supports the broader thesis. He then shows ETH's BTC, when the deck was made, around 0.0403 below its 8-year average. If the ratio mean reverts or breaks out, ETH can outperform BTC, key to the 10K case. Here's the matrix page. Rows are BTC prices. Columns are ETH versus BTC ratios. Cells are ETH prices. In an easing macro, Tom thinks BTC could be 150 CAD or 250 CAD by end 2025. If ETH versus BTC returns to the long-run average 0.048 or approaches the 2021 high at 0.87, the matrix gives you the $10 handle. Then he lays out a long-term valuation. Ethereum's network value near $7 trillion, implying roughly 60,000 per ETH. That's based on two lenses, a replacement cost lens for banking, 4 TE, and a payment rails lens, 3 TALs. Total 7 trillion. Divide by 120 N ETH, you get about 58 CAL or 60K. He shows how the $4 is inferred from the market caps of top US banks, JPM, BAC, WFC, CGS, about 2.1 TELs, roughly 52% of commercial bank assets, implying 3.8 to 4 TED for the system. If Ethereum absorbs parts of that stack, lending, custody, issuance, it can contest that value pool. For the $3 payment lens, global rails process 450B transactions a year. If settlement moves on-chain, annual fees could be around $0.1, valued at 30 KIs like Visa, MasterCard, you get near $3. One practical note from me, enterprise flows would sit on L2, with L1 mainly capturing blob DA fees, so layer fee splits matter. He revisits the matrix with a payment rails tag. ETH versus BTC at 0.25 would imply ETH could flip BTC by market cap. Finally, another TA angle. Fundstrat's Mark Newton calls for 9 collars by Jan 2026. That adds weight to the $10 case. My take as an independent researcher, $10 is ambitious but cycle plausible if macro eases, ETH, BTC strengthens, and stablecoin RWA rails keep compounding. $60 is a decade-long vision. It assumes Ethereum truly becomes the global settlement layer and financial internet. We'll track the path and keep testing assumptions. Thanks for watching. I'm TQ2050. See you next time.